Hey everyone, welcome to the KE Report and a daily editorial. This time featuring Craig Hemke, founder and editor of TF Metals Report. We'll post a link to Craig's site in the show notes. And as always, we're going to be following up with Craig to discuss a couple of the headlines around the precious metals sector and some of the at least short-term price moves we've seen with gold continuing to look at that 3,000 number, but not quite reaching it, and silver volatile right around that $32, $33. Craig, a couple of the headlines that a lot of the gold bugs have been talking about deal with gold potentially being revalued by the U.S. Treasury up from that about $42 an ounce that it is currently priced at to who knows what level they would revalue that at and what sort of flexibility it would give them on their balance sheet. Let's start with that. I know you've commented before on this, and we've had some other guests comment on it, but just curious your thoughts on the potential of this happening. If you had to put odds on it, what do you think the odds are of the U.S. actually revaluing its gold?
Ooh, that's a good question, Corey. I hadn't thought of it that way. Let me ponder that while I answer the first part of your question. There's seemingly something afoot. You got all these kind of dots out there, from the spreads that began to widen in early December of spot versus futures that then went away and then widened back out and then went away. And this keeps happening. You've got all this stuff about how much gold is being onshored into the U.S. It's apparently related, they say it's related to tariffs and got to get gold over here in case Trump institutes a 25% tariff on England and you can't export gold out of London and you got to get it here now. And then you got this talk about a sovereign wealth fund and what would, the Trump signed an executive order that he wants to create one, but from where would you get the money to put in that thing? They're already running a $2 trillion deficit for this year. We're going to run that up to $4 trillion so you can put $2 trillion in your sovereign wealth fund. I could go on and on, but there's all these dots out there that guys like me with too much time on their hands and access to the internet can, speculate as to how these dots might connect. And that is one of the ways. You would think, okay, maybe the plan is to somehow monetize that gold in a way that they could use it to either pay down the debt. That's kind of the idea of the sinking fund that Alexander Hamilton was fond of. It actually has origins going all the way back like to the 17th century. This idea, a sinking fund, is like all three of us, are carrying debt. It's like your, you pay credit card debt of $10,000, and you decide you can't pay it. You rather than paying it off right away, you're like, okay, I'm just going to set aside some of my paycheck every month, and try to get $2,000 a year, and then then eventually I have $10,000. I can pay that off. So, is there a way you could revalue gold as part of a sinking fund to pay off some of the existing debt? Is there a way you could revalue gold then to monetize it in the form of treasuries to fund your sovereign wealth fund? All of those would connect then to you'd want to have your gold on shore, and you'd also want to know how much you actually have, which leads us to another one of these dots. All of a sudden, this talk about finding out what's in Fort Knox and the other depositories, and not just walking around, with a camera saying, oh, look at that, look at all that shiny gold. Actually getting in there and weighing and assaying and registering and trying to find the title to every single bar. I mean, there's all these things that are out there, and some of them connect to maybe revaluing that gold from $42.22 on the U.S. balance sheet. Anyway, at the end of the day, what's the likelihood of this happening? Well, given my 15-year build level of cynicism as a gold advocate, it's probably 1%. I'm sure it's greater than that, again, with all these dots. I don't know, I give it one chance in 4 at this point. How about that?
That's pretty generous, Craig. And yeah, I'm not holding out any big hopes on seeing that all come together. But the idea was floated out by Scott Bessent that they would like to, look at shoring up their balance sheet and some of the assets on it. And then he came back out in another interview and said, well, when he was asked, hey, are you talking about revaluing the gold? And he goes, no, I wasn't thinking about that. But he never really told us what he was thinking about revaluing. And we were talking off mic about what could it even be on the U.S. Assets that they could revalue if it's not gold. And he's also simultaneously talked about a sovereign wealth fund, which you brought up. And the idea, like you mentioned, how would you fund it? What would the sovereign wealth fund be used for? What could they do if they don't use gold? Have people thought about this too much? Have we gone way off into the weeds here with this discussion, or as a whole sector? Or is there something to this where maybe they're not showing their cards yet?
Well, what is a sovereign wealth fund? We don't have one in the U.S. Typically, it's like something you'd find like in the Gulf states, where they own all of their oil production, the state does, and they sell it all, and through the petrodollar agreement for dollars, and then they store up all this cash, and they decide, well, what we have left over, we're going to put in a sovereign wealth fund, and we're going to acquire, like soccer teams, or we're going to start a new golf tour or whatever, right? So Trump has seen that idea, and he's like, well, we have our own sovereign wealth fund. Okay, well, that's a nice idea. But how is the U.S. going to fund a sovereign wealth fund? So anyway, he signs this executive order saying he wants to look into creating one back in early February. And as he does this, how he does it. He's in the Oval Office and he signs his name in the big letters and he holds it up, Everybody's seen him do that. So he's doing this, and he's got Bessent on his right, and I don't even know who the other dude was on his left. Anyway, and he says something like, yeah, Scott's got some interesting ideas here as to what we can do. Scott, you want to talk about that for a second? And old Scott leans in and he says, well, exactly what he said, because I wrote it down. Within the next 12 months, we're going to monetize the asset side of the U.S. balance sheet, and we're going to put these assets to work. He went on, he said, we've studied the best practices as done around the world. And it's a combination of liquid assets and assets that we have in this country. Okay, that sounds good. The only class that I took in college that I dropped, that I wanted no part of, was Accounting 101. Man, just too black and white for me. You always, the columns got to equal each other, right? When you do a balance sheet, assets equal liabilities. Okay. Well, in the U.S., on the liability side, we've got our $36.5 trillion in debt, some other liability. I think the official number from the Treasury Department is like $45 trillion or something like that as liabilities. But do we have $45 trillion of assets? No. They list about $6 trillion of assets. Okay. Well, that's probably a discussion for another day, all part of why I own gold. But then you think, okay, well, what's he talking about then? We're going to monetize the asset side of the balance sheet. Well, anybody can look this up. I looked it all up yesterday. Look at the Treasury statement from the end of the fiscal year last year at the end of September. What is on the asset side of the balance sheet? And it's like guns and ammo, mineral stocks that we have for the defense industry, office buildings and furniture. I kid you not. This is what it's listed as. These are the assets. The student loans, right? That's somebody else's liability. It's a federal government's asset. $1.7 trillion in student loans. How could you monetize that? You could, sell it off to a collection agency at 50 cents on the dollar? I don't know. And then you get all the way down to the end, about $1 trillion in cash, which again, the Treasury has to hold, as keep all the different funding mechanisms going. And then you've got the gold. Of course, Bessent then came out as everybody was starting to figure this out, and kind of parsing through his words and looking at all these dots I talked about. And Bessent comes out and says, oh, no, that's not revaluing gold. That's not what I was thinking. Of course, nobody then followed up and said, well, what were you thinking? You're going to monetize the office chairs and all the cubicles and all your office buildings and at the Pentagon? No. Anyway, he just left it at that. Of course, he wasn't. Can you even imagine, guys, if in that interview last Wednesday, he said, yeah, that's exactly what we're thinking, and we're just trying to come up with a number. Oh, God, what would we be talking about today? So anyway, I don't believe him. If that is the direction they're going to go, I think he was just trying to buy some time with that interview last week.
Craig, what would happen to the gold market in terms of pricing, in your eyes, if the Fed did reprice their gold, whether they repriced it to $1,000, $2,000, $3,000 an ounce? What does that change in the pricing model in, let's say, the futures or the spot market?
I don't know. See, that's the thing. I've been thinking about that too. I remember when this used to be discussed 10 years ago, it's like, oh, you can't do that. It would be horribly inflationary. I don't know. Would it? I guess it depends on if you use that repriced gold as, a piggy bank that you can flush a whole bunch of new cash out. But what did we flush out? $5 trillion in cash in COVID response, and that drove the CPI to 9%. So if you revalued gold 5 trillion, which would be like about $20,000 or so, I think if I'm doing the mental math in my head, would that drive a big spike? I guess what I'm saying is this is one of these theoretical questions. It's not been done before, so we don't know. What would the inflation component be? The other part, as you mentioned, Corey, what would that do to the international price? I don't know. I mean, if the U.S. government comes out and says, we are going to revalue gold at $10,000 an ounce on our balance sheet, that makes our gold worth $2.5 trillion. We're going to use it to index some 50-year Treasury bonds to gold so that people actually buy them. And we're going to take that $2.5 trillion and we're going to park it in our sovereign wealth fund and we're going to buy Greenland. Whatever. If the U.S. says it's worth $10,000 an ounce, again, I'm just picking a number out of my rear end, does that mean that's what gold trades at? I don't know. Would they have to actually say we are buyers of gold at $10,000 an ounce to make that happen? Well, I don't think they'd be buying any gold at 10, because again, that kind of goes against what they're trying to accomplish. I don't know. This is all stuff we've not seen before. You wouldn't think that if the U.S. effectively monetizes it and states it's worth $10,000 an ounce, that it would stay at $3,000 an ounce. But stranger things have happened, right? I mean, anybody's followed gold for any period of time wouldn't be surprised by anything.
Well, it's a good point, Greg, and I have seen people speculating that, well, there's a couple of different camps. Some would say, hey, you'd have to do it at a discount today's pricing because what if it pulls back? Some are using today's pricing, $2,800, $2,900 gold. But there were a lot of people that said, hey, what if they marked it up to $15,000 or $20,000 an ounce? What could that do? What would that do to other central bank buying? Would the rest of the world go, holy crap, I need to start buying some gold and even add more to our central bank balance sheets? So it's an interesting question to ponder. Let's bring it back down into the more mundane world of the price action we've been seeing, though, on gold and silver. To Corey's point, gold has gotten close to 3,000, but hasn't been able to quite get above it. Silver got whacked today. But you were talking about what happened in gold when a lot of the futures contracts rolled over from one month to the next. And that same thing is getting ready to happen in silver. How are you looking at the price action if we remove all the narrative and just look at what's happening on the futures contracts versus the physical?
Well, we can start with silver. The $33 level is curious. It's been an important level. It was back in 2011 as price was moving higher, and it has been now for about the last 6-8 months. It try to get up through 33 and fall back, even just the last 3 weeks. Silver's bumping through 33 and then just gets hammered on Fridays and can't seem to close above 33. That seems to be a key level for making an assault on those highs that we saw back in late October, up near 35.50 or so. Silver probably have trouble this week because, as you mentioned, the current front month of silver is the March contract. It has been the front month since the December went off back at the end of November, which seems like, eons ago. So what's going on in silver this week? Well, you've got options on the March contract that expire on Tuesday at the COMEX close. That typically causes price to do funny things. And then that March contract will go off the board and into its, called delivery phase Thursday night. Here will be an interesting thing to watch. Most folks have heard about gold deliveries and how they've been surging to record levels. The February gold contract is going to be the highest amount of deliveries ever seen. Already we're about 75,000 contracts, which is something like 225 or 30 metric tons on the February contract. And a whole bunch showed up in January as well, which was a non-delivery month. And we've got a lot of open interest in the March. So gold's had its own, massive surge of deliveries. So what's going to happen with silver? Let's just see how many contracts are standing Thursday night when it goes off the board. Back in December, there were about 8,000 that stood. Total deliveries were about 9,000 contracts. I don't know, there's a chance we could have 15,000 standing and maybe make a run at 20,000 total. That'd be 100 million ounces. There's about 98 million ounces in the registered category right now. The entire vault's about 380 million. So it's not like, oh, the COMEX is going to fail. We're not playing that game. But it'll be very interesting to see as we get later in the week if silver doesn't have some of the same delivery demands that gold's been having as of late.
Who do you think these investors are that are taking these deliveries rather than just kind of rolling these contracts over?
I know, that's another question. I mean, we can sit there and look at the delivery reports that come out every night, and we can see who's issuing the contracts. Vast majority of like in February gold, well, I shouldn't say vast majority, but the majority in February gold has been the main bullion banks, the house account of JP Morgan, the house account of HSBC, delivering well in excess of the position limit, but they're just hedging, but like 14,000 contracts. Okay, you put those three together and you get about 2/3, maybe not quite 2/3 of the total deliveries. And then you get this disparate list. Oh, a couple of house accounts of some of the other bullion banks, but mainly customer accounts of who has been taking delivery. Again, now we don't see the metal leaving the exchange. All we see is just the shift, of the warrants and the warehouse receipts. So that's why we always say delivery in those tunes. If you can picture me doing quotation marks, air quotes around delivery. But again, who's taking it? You can also, you can see a lot of the gold going into like the Brinks vault. I saw somebody on Twitter say that, that's the U.S. government vault. I don't know. Corey, it is all so opaque that it's almost impossible. Is it made to be opaque so that it is impossible to be able to know what's going on? I don't know. I'll just finish with this. You go back to, I don't know, it was about 2013 or 14 when we first started, just out of the blue one day, the CME started putting on the disclaimer at the bottom of their gold stock and their silver stock reports. And the disclaimer has been there ever since, just copied and pasted every day. The information in this report is taken from sources believed to be reliable. However, the CME disclaims all liability whatsoever with regard to its accuracy or completeness. Okay. So again, anyway, I chuckle and chortle at all this kind of stuff, but I am answering your question. I don't know. And I don't think we can take as gospel. The CME is telling us not to take as gospel what they put out. So how could we ever know?
Yeah, you don't know. I don't think they know, and nobody knows. But let's look at some things that we do know. Look at the contracts, the way they're priced in the future versus where spot is, the physical. And there is an arbitrage there. And you were mentioning off mic that there's people that could play that arbitrage right now if they had confidence in delivery, but there's not confidence delivery on silver. And the same kind of things happened before in gold. Maybe talk about the spread between physical and the contracts. And like you say, it was getting really wide in gold for a while, even from London to New York. That's why we saw some people playing that. What do you think's going on here with these weird spreads?
Well, that's the thing. There shouldn't be. You could always have a little bit of a spread from spot to futures, just from the time component, but it shouldn't be $40 in gold, and it shouldn't be more than $1 in silver. That doesn't make any sense, because if there's confidence in that trade, then the arbitrage takes place where you buy the spot and you sell the futures contract. And you do it enough in size that you're buying here, you're selling there, and that spread collapses. So now, again, it can happen one of two. You can buy spot, you can sell futures. And so what typically happens is you get close to that futures contract going off the board, that all of the rolling of positions is kind of a net impact on the selling part of that future side, and that spread collapses. So when these spreads first started appearing in December, about a month after Trump was elected, in December, early December, peaking on December the 11th, that spread in gold got all the way up to like $35. And then here came the December FOMC meeting, some end of year window dressing, all that stuff, and it went away. And I thought, okay, well, that was a one-time deal. Well, then here it came again in January, and it got up to like $43. It was $40 earlier this month too. So why does this keep appearing? Again, it shouldn't. You should be able to buy the spot, sell the future, and enough people should be doing it in size that the spread collapses. But even as I speak, the spread is about $15.50 in gold. Here's what's even weirder. And again, mentioning silver, which is that March silver contract is going off the board in 2 days. I'm sorry, 3 days. Right now, as I speak, it's about 35 cents, the spread. Okay, you would think, right? Somebody would go, okay, I can buy the spot contract, I can sell the futures contract, I can capture that 35 cents pretty easily. Well, what are you doing? You're buying spot and you're promising essentially to deliver, otherwise, or you're just naked short. And the reason why that arbitrage isn't getting done in size to collapse it is because someone's not confident that they're going to get the spot that they're buying in time to deliver against the short. Now, again, maybe that's why all this metal's flowing across, because we got to get more metal over here so we can execute that trade. But it shouldn't be happening, I guess is what I'm getting at, especially in that silver contract this close to expiration. And so there is definitely not only a tightness, some people would say, well, the metal's just in the wrong place. It's a logistical issue, but it's also a lack of confidence. What I don't want to do is buy the spot and short the futures because I'm not confident that I'm going to get my spot delivered to me enough in time that I can deliver it against my short during the month of March. And if I don't have it delivered, then I'm naked. I'm naked short. And that's, in a rally, that's not a position you want to be in. So anyway, so I'm sorry if I give you a long answer, and I hope I not sound like I'm talking in circles, but the moral of the story is it certainly shouldn't be 35 cents in silver with 3 days to go for expiration, but it should never have been as much as $1.20 or whatever it got to earlier this month. Again, put that in that collection of dots that we started out talking about when we began this call. All these dots that maybe they connect, maybe they don't. Maybe, I'm just John Nash with all this shit pinned to a wall and I'm stringing strings trying to connect it all, and in the end, I'm just a lunatic. He was a very smart lunatic, but you get the idea. Maybe there's something there, maybe there isn't. And that's all, I guess, will be revealed in time.
Yeah, there's always a lot to talk about, but what actually moves price, I think also just interesting and important to look at the charts and see where price is moving. Price has been moving higher. What about the gold stocks then? Just a quick little touch in on gold stocks. We've had a number of earnings reports come out. Again, a real mixed bag of how the market reacted to them all, but overall, these companies are making record revenues and a lot of record incomes. What's your takeaway from some of the interest we've seen in the stocks, which in all fairness, GDX, GDXJ, those have done very well to start the year?
Yes, they have. Almost going straight up until we got to late last week. We've discussed my disdain for Newmont ad nauseum in these calls. And even they finally dropped their all-in sustaining cost by like 9% from third quarter to fourth quarter. And their earnings look great. Everything looked great. But then they guided higher for their cost for next year. And that was used as explanation to hit them for whatever, $3 back on Friday. A response to the last two earnings. The report for the second quarter that came out in October, or the third quarter that came out in October, and the reaction to the report last week has cost them $12 the next day. If you add those two together, $9 back in October and $3 back on Friday. It's really remarkable. At the risk of just kind of lumping them all together and grouping them all together, and the fact that the GDX is pulled back here, I think to me, there's still this view of the sector that okay, well, the earnings came out. We're going to buy the rumor that they're going to be good. And then they are good. And then we're going to sell the news because what more news is there going to be until about, 6 weeks from now when we start getting the latest production reports and everybody starts getting excited about the next round of earnings. So you get these pauses. And this has happened forever. It hasn't, and it seems to be happening again now, where you get this rally and then the actual news comes out. The generalist investor goes, well, that's now dead money until the next time there's an earnings report. So I think I'll sell here and go put it someplace else for a while and come back and revisit it again in 6 or 8 weeks. And that seems to be happening again.
You're right. It does seem to. One other thing is that they also guided for lower production this year too. So a couple other things that I guess some people can hang on the negatives, but either way, there's still a lot of stocks that are doing very well in the gold space and taking advantage of these higher prices. All companies are taking advantage of the higher prices. They just need to be doing something on their company front, either lowering costs or increasing production that would also help. Craig, as always, great chatting with you. Again, Craig Hemke, founder and editor of tfmetalsreport.com. Click that link in the show notes. Craig, have a great rest of your week.
Thanks, guys. It's always fun.